The W&A Global Equity Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $1 million with a 100% equity objective. This is a new composite that was previously marketed by W&A. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account that is under $1 million. These accounts are added to the composite at the end of the month that the value meets or exceeds $1 million. 3. Any account that is not invested in accordance with the W&A Global Equity Model, i.e. large cash positions on new accounts, addition of non-equity components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $1 million. Unmanaged assets are brought in, or the investment objective of the client is altered. Past performance for these accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. As is the case with all investments, the potential for profit is accompanied with the possibility of loss. A description of the equity indexes listed for comparison in the table provided in the presentation are provided herein. The S&P 500 is considered a broad index for the equity market, seeking to represent the returns of the top 500 publicly traded companies. The MSCI EAFE is a market capitalization weighted index, maintained by Morgan Stanley Capital International, MSCI, which includes a selection of stocks from 21 developed markets, but excludes those from the U.S. and Canada. The Russell 2000 is a small-cap stock market index of the bottom 2,000 stocks in the Russell 3000. It is the most widely quoted measure of the overall performance of the small-cap to mid-cap company shares. The MSCI Emerging Markets Index is a market capitalization weighted index maintained by Morgan Stanley Capital International, MSCI, designed to measure the equity market performance across 23 emerging markets, EM. The MSCI ACWI Investable Market Index represents more than 9,000 securities across large, mid, and small cap size segments, and across style and sector segments in 46 developed and emerging markets. The W&A Global Fixed Income Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $500,000 with a 100% fixed income objective. This is a new composite that was previously marketed by W&A. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account under $500,000. These accounts are added to the composite at the end of the month that the value meets or exceeds $500,000. 3. Any account that is not invested in accordance with the W&A Global Fixed Income Model, i.e. large cash positions on new accounts, addition of non-fixed income components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $500,000. Unmanaged assets or non-modal assets are added, or the investment objective of the account is altered. Past performance for the accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. The composite may or may not be the actual allocation determined to be appropriate for any individual client, and a client may or may not follow the composite. Clients with the allocation shown may have different results based on capital flows, timing of rebalancing decisions, fees charged, or other factors. As is the case with all investments, the potential for profit is accompanied with the potential of loss. The index used for comparison is the Barclays Capital Aggregate Bond Index. It is a broad-range index that represents the total return of the bond market. It covers most U.S.-traded bonds and some foreign bonds traded in the U.S. The index information is supplied to W&A by a third-party quotation service. Investors should note that investments cannot be made directly into this index. The Leuthold presentation is not a solicitation or offer to buy or sell securities. The Leuthold Group, LLC provides research to institutional investors. It is also a registered investment advisor that uses its own research, along with other data, in making investment decisions for its managed accounts. As a result, the Leuthold Group, LLC may have executed transactions for its managed accounts and securities mentioned prior to this publication. The information contained in the Leuthold Group LLC research is not, without additional data and analysis, sufficient to form the basis of an investment decision regarding any one security. The research reflects the Leuthold Group LLC's views as of the date of publication, which are subject to change without notice. The Leuthold Group LLC does not undertake to give notice of any change in its views regarding a particular industry prior to publication of their next research report covering that industry in the normal course of business. The Luthold Group LLC may make investment decisions for its managed accounts that are inconsistent with, or contrary to, the views expressed in current Luthold Group LLC reports. Wheaton Investors LP, Wheaton & Company LP's parent company, owns 22% of Luthold Group's securities. A managing director of Wheaton & Company LP is a member of the Luthold Group LLC Board of Directors. Wheaton & Company LP, member FINRA, NASDAQ, and SIPC.
I hope y'all get it. I mean, this is where we're trying to grow strategically. If you've got $1 million portfolio and it goes up 14%, you make $140,000. Through smart financial planning like that from Kathy and Mark, and we got a whole bunch of people at the firm, that's a 14% rate of return just on financial planning. So there are ways to make money in a flat environment. One of the other ways we add alpha is through communications, and specifically helping clients navigate through turbulent times such as these. So let's go back to the Smiths, which is a great, I think, case study. So the Smiths have now stepped into retirement. And because they've been diligent with their savings and they followed all of the advice of their financial advisors, they now can live a lifestyle of $200,000 a year in retirement. And we run it through our probability gunculator. And what we find out is they've actually got a 94% chance of all their financial hopes and dreams coming true. So they are very excited, they're confident, they launch off into retirement, and guess what? It's 2008, right? And so the market goes down about 50%, the Smith total investable asset pool goes down 31%, and as my guru, Mike Tyson, taught me, everybody has a plan until you get punched in the mouth. So Bob gets really nervous. He regrets investing this money in the markets. He really, really wants to sell and preserve his capital. Betty is freaking out because she doesn't understand what's going on and thinks that Bob may have to go back to work. Well, we calmed everybody down. We sat them in the office and we went back through the probability analysis. And yes, if you focus on the long term, the market has come down, but your probability of all your hopes and dreams coming true has fallen a lot less than the market. So we've gone from 90% basically to 80%. Now how do you feel? Well, I feel okay. So I'm proud to report that Bob and Betty are in a Winnebago somewhere near Yosemite, and they're very happy because they didn't sell, and they ended up getting the full recovery of that market between 2009 and where we are today. And so by staying convicted, by staying true to the long term and staying in communication with W&A, it ended up being a happy period for them, even though it was very stressful. Now, for average investors, and you've seen this slide before, but I think it's so important, if you go back and you look over the last 20 years and you separate out stock investors and bond investors, the average investor in the United States of America earns a return of about 5% annualized over the last 20 years, where the S&P 500 compounded at about 10%. So they're getting half of the rate of return. And this isn't my data, it's Dow bars, and it's good, I've looked through it. But basically, they make bad timing decisions. They tend to sell low and buy high, and that's what causes the depression in their overall returns. For bond investors, it's even worse. They just don't even participate. So the bond returns are 5.5%. The average bond investor gets nothing because it sits in cash. Now, if we can walk our investors through the probability analysis and keep them focused on the long term, we keep them from being distracted by the short-term turbulence of the market, which can, like a rope-a-dope strategy, to use another boxing analogy, can cause a significant problem. So by giving you high quality, high frequency, and reassuring communication in turbulent markets, we think we can deliver a lot of alpha. All right. Next, I want to take a moment and introduce our guest speaker, who I'm excited to bring before you. He's the one that's going to tell you whether the market's going to go up or not, and he's good at it. So Doug Ramsey is the Chief Investment Officer of the Luthold Group and is the Chief Investment Officer also of the Luthold Global Fund, which we own. Those of you who are clients own it, and I own it, and so does my mom. Inside the W&A Global Equity Portfolio. And I will tell you that Doug has been right as rain on these markets. That's probably like being on the cover of the Wheaties box. Should I take that back? Sports Illustrated, yeah. But he's been right as rain on those markets, as the Wall Street Journal has commented, as CNBC has commented, and just to prove that, so far year to date, and I'd cut this through the 13th of February, the primary index, world index, was down about 10%. Doug's portfolio was down about half that, which is a significant amount of alpha. The question is, for us and for him, will this continue? With that, Doug Ramsey.